It's December 24th, Christmas Eve. The Western world is busy wrapping presents and knocking back eggnog, assuming the financial year is winding down. The COMEX is technically open for a half-day session, but the trading pits are ghost towns. Liquidity is supposed to be zero. The tamp-down teams are off duty, and that complacency is exactly why the next move was so catastrophic for the paper shorts. Because while the West was sleeping off the holiday, the East didn't just nudge the silver price. They completely broke the paper peg. I'm not hyping this up. This isn't doom porn for clicks. We are witnessing price action that shouldn't physically exist in a rigged system. The fundamental lies holding the fiat markets together are failing in real time, and the sheeple aren't watching. Not because it doesn't matter, but because the banksters know holidays are the perfect cover. At 3:30 a.m. Eastern, the Shanghai Gold Exchange and the Shanghai Futures Exchange kicked open the doors. What happened in the first half hour wasn't just volatility. It was a complete decoupling, the kind of vertical move that makes risk managers wake up screaming. This wasn't a glitch. This was the dam breaking. We've been screaming about the East-West disconnect for months. We showed you the physical bars draining out of Western vaults while the COMEX kept shuffling paper contracts. Two markets rigged together for decades finally snapping apart. Today, that slow bleed turned into a massive hemorrhage. Silver on the SGE closed at $77.89 an ounce in U.S. terms. Meanwhile, the COMEX paper price was dragging its feet near 72. Same metal, same second. A spread that massive isn't an inefficiency. It's a siren. It means the arbitrage game, the mechanism keeping the fake spot price aligned with reality, is dead. And when the arbitrage machine breaks, the whole casino goes haywire, timeframes collapse, volatility goes parabolic, and cracks that usually take years to show up start ripping open in a matter of days. This is how the fiat system ends, not with a bang, but quietly, on a holiday, when nobody is watching the charts. If you want to know what this means for your stack and the future of money, buckle up and listen. Let's break down the math, because this is where the manipulation becomes undeniable. Silver in Shanghai hit $77.89, real US dollars, not yuan, not some Forex trick, actual fiat value. At that exact moment, the COMEX paper clowns were trading around $72. Depending on the refresh rate, maybe a few cents different, but firmly suppressed, below the Shanghai reality. That is a spread of roughly $5.66 an ounce. Let that sink in. In a rigged commodity market, that gap is impossible, not for minutes, definitely not for hours. Since the 80s, the whole scam relied on one rule: identical assets must converge via arbitrage. Normally, the vultures would close that gap instantly. Bullion banks, algos, and the hedge funds would back up the truck in New York, ship the Middle East, dump it in Shanghai, and pocket the risk-free cash. That's not gambling, that's mechanics. That's how they keep the global price suppressed. But nobody moved. The spread didn't close, it stuck. Then it blew out wider. That's the signal. When there's free money on the table and the banks won't touch it, it means the trade is broken. Not because they're dumb, but because the metal isn't there to move. This is the end of the paper illusion. The number on your COMEX screen isn't the price of silver. It's the price of a lie, a paper promise, an IOU. Try to turn that slip of paper into physical bars and the system freezes, delivery delays, massive premiums. Sorry, out of stock. Shanghai is showing you the real price of physical, the price of metal you can actually hold. New York is showing you a fantasy number based on infinite paper supply. The rig doesn't fail all at once. It snaps at the weakest point, and right now that weak point is the lie that paper contracts are as good as physical metal. When that confidence evaporates, the repricing will be instant. To get why this spread is sticking, you have to understand how a healthy market works, and then realize we don't have one. Normally, a $5 gap would trigger a stampede. Every bullion bank and high-frequency bot would be buying cheap COMEX silver to flip it for the expensive Shanghai price. No crystal ball needed, no speculation, just pure arbitrage execution. But that trade is dead in the water. There is only one reason a risk-free arbitrage profit gets ignored. You can't physically move the metal. When the big boys try to buy silver in New York at $72 and stand for delivery, the wheels come off. The liquidity on the screen is a mirage. As soon as you ask for the bars, the inventory vanishes, delays pile up, premiums skyrocket, and eventually they just stop answering the phone. This is the moment where the paper price and the physical price file for divorce. Shanghai is bidding $77.89 because they aren't playing video games with charts. They want the metal. They are draining the vaults. They need possession. And they'll pay whatever it takes to secure the goods. That is why the arbitrage is broken. You cannot ship paper promises to a buyer who demands physical bars. Once arbitrage dies, price discovery is gone. The whole global scam rests on the belief that you can always get delivery if you pay. When that myth gets busted, prices stop matching up and start fracturing locally. This is the shift from a financialized market to a physical one. The question isn't, what's the spot price anymore? The question is, do you actually have any silver? And once the shortage goes mainstream, price goes vertical without asking permission. When we hit this stage, velocity is king. Most people just stare at the price tag. The real stackers watch how fast it's moving. Velocity tells you the truth. It shows if the move is a managed retreat or a total loss of control by the shorts. Normies think in straight lines. If silver goes up $10 in 10 months, they expect the next $10 to take just as long. That logic works in a managed market, but it fails when the rig breaks. When the manipulation fails, price doesn't walk. It teleports. Look at the timeline of this breakout. The grind from 20 to 30 took 5 months. 30 to 40, another 5 months. Boring, controlled, safe. That's a managed bull market. Gives you time to stack dollar cost average and stay calm. Then the suppression algos lost control. 40 to 50 took a month. 50 to 60 happened in less than 2 weeks. Time is compressing by 70%. The sellers are gone. The resistance lines are gone. Liquidity is evaporating. The slow climb just turned into a moonshot. This is the parabolic blow-off. The moment technical analysis becomes useless and survival instincts kick in. Dips are shallow and terrifyingly fast. Volatility explodes. The smart money switches from accumulate to panic buy. He who hesitates pays double. At this point, nobody cares about the future price targets. They just want to know if they can get metal at all. Scarcity is the new fundamental. Urgency is the new sentiment. Parabolic moves don't stop because the price gets too high. They stop because the infrastructure snaps. Exchanges halt trading. Force majeure is declared. Trust hits zero. And right now, it isn't just the price that's breaking. It's the entire fractional reserve system underneath it. To see why the banksters are sweating, you need to look under the hood. Forget the candles, look at the plumbing. This is where the retail traders get bored and the insiders get terrified. We're talking about swap rates and lease rates. This morning we got a massive red alert. The 1-year silver swap rate minus US rates went deep negative. Not a blip, not a glitch, negative 7%. That number is the physical market screaming that there is no metal left. In a normal world future, silver should cost more than spot silver. Storage fees, insurance, security. It all adds up. That's called contango, and it means the market is sane. But silver has flipped into massive backwardation. The market is paying a huge premium just to get metal in hand today. Buyers are eating a 7% loss just to avoid waiting. That's not trading. That's a run on the bank. Here's the reality in plain English. The market is screaming, I don't trust future delivery. I need physical metal in hand right now. This isn't paper traders chasing quick fiat profits. This is coming from entities that can't survive a supply failure. We're talking industrial whales, manufacturers, global supply chains, massive operations where assembly lines halt without the white metal. They ignore the technical charts. They ignore price smashes. They only care about one thing, securing the metal to stay alive. Backwardation. This deep isn't a glitch. It's a full-blown supply shock. Just-in-time delivery is dead. Buyers are bypassing the paper games, reaching straight into the vaults and draining physical inventory because they know future promises are worthless. We've reached the tipping point where the market stops functioning normally and starts acting like a systemic stress test. To really grasp how critical this moment is, you need the historical context. We've seen silver backwardation in the past, but never this extreme and never for these fundamental reasons. Most stackers point to 1980 and the infamous Hunt Brothers squeeze, but that comparison is dangerously misleading today. Back in 1980, it was pure speculation. 3 tycoons used massive leverage to corner futures contracts. It was a financial squeeze, not a physical shortage. Since it ran on margin debt, the exchanges killed it easily. They hiked margin requirements, cut liquidity, and simply changed the rules until the squeeze imploded. 2011 was similar. Backwardation returned as retail stackers rushed in after the GFC, fearing inflation and dollar collapse. It felt huge, but it was driven by sentiment, and emotional markets are easy to break. Hike margins, slam the spot price, trigger panic selling, and shake out the weak hands. Game over? This time the beast is different. This backwardation isn't speculators chasing gains, it's industrial giants and sovereign nations draining the physical supply. These buyers aren't trading on margin, they aren't emotional, and unlike paper traders, they can't just close their positions and walk away. A solar panel maker can't stop the line because of a price dip. Tech firms can't wait for a tamp down when orders are due. These buyers are price inelastic. They'll pay any premium necessary because the cost of running out of silver destroys their business faster than high prices. That's why this setup is infinitely more dangerous than past squeezes. You can't shake these buyers with volatility. Changing margin rules won't stop them. They aren't trading paper contracts for profit, they are securing physical metal for survival. When the market shifts from paper speculation to mandatory physical demand, the game changes. Price stops rationing demand. Only physical availability matters. Once a strategic metal enters that phase, volatility isn't the main risk anymore. Total unavailability is. Now get inside the head of the bullion banks, because this is where the situation turns from risky to existential. These institutions exist to provide liquidity. They sit between buyers and sellers, skimming profits on spreads by ensuring the market flows. But that fractional reserve model only works if physical metal can be sourced instantly without hesitation. Today, that guarantee is disintegrating. A bank can sell paper silver without holding an ounce because it trusts the swap market. If delivery is demanded, it borrows metal from another vault, settles the debt, and returns it later. That trust is the foundation of the entire paper scheme. When swap rates crash deep into negative territory, that trust evaporates in a heartbeat. Banks stop leasing metal to each other, not because they're mean, but because they're absolutely terrified. Picture a risk manager getting a delivery notice for 1 million ounces. Usually, it's routine. Now, it's a nightmare. They try to source the bars on the interbank market, but get silence or refusal. Everyone is clutching their physical stash. Everyone is in protection mode. Suddenly, the bank is caught naked short. They promised metal they can't secure. If they hit the open market to buy their own demand spikes, the price blowing up their short positions across the board. Every move just tightens the noose. This is the ultimate liquidity death spiral. Banks holding physical inventory yank it from circulation. No more leasing, no more swaps. They retreat into a defensive shell. Liquidity dries up not from a lack of demand, but because nobody will let go of the real stuff. This is how the system freezes from the inside out, not with a loud crash, but with a silent, deadly paralysis. And when interbank trust shatters, there's no emergency reset button fast enough to save the system. This is where the same question comes up in every form. Won't the authorities stop this? Can't regulators intervene? Halt. Trading change the rules and force the system back into line like they always have. It's a reasonable question, but it reveals how deeply most people still believe the illusion that this rigged market is ultimately controllable. Sure, the COMEX in New York can halt futures. They can declare force majeure. They can set positions to liquidation only and turn off the screens. Those tools are in the playbook. But here is the fatal flaw in that logic. You can halt the paper game, but you cannot halt physical reality. If the futures market in New York goes dark tomorrow, silver doesn't stop being essential. Factories don't shut down machines. Supply contracts don't vanish. Solar panels still need silver paste. Electronics still need contacts. Batteries still need metal. The real economy doesn't pause just because a manipulated screen stops updating. Shanghai doesn't need New York's permission to operate. The physical trade continues because it has to. Metal flows to whoever has the cash, not the regulations. When the paper casino freezes, the real market just routes around it. If they halt futures, backwardation doesn't end, it explodes. Swap rates dive deeper into the abyss. Scarcity becomes undeniable, and the price for actual physical metal rips higher faster. This is how true price discovery returns. Not through Fed meetings, but sheer necessity. Once buyers bypass the COMEX, the spot price becomes a joke. A price with no metal behind it is just a fantasy number, and without trust, it's worthless. This isn't a glitch, it's a monetary regime change, and once the cartel loses control at this level, they almost never get it back. Now we get to the smoking gun where theory hits reality. You can argue about price manipulation, you can debate the charts, but draining inventory levels do not lie. While most people were glued to the spot price screens, the physical metal was moving. Massive quantities of deliverable silver were being drained from Western vaults exactly when prices were hitting highs. That is the opposite of normal market behavior. When prices pump, supply should appear. Sellers should sell. Instead, the silver was leaving the building. This is exactly what a modern run on the vaults looks like. No lines around the block, no street panic, just forklifts and armored trucks quietly stripping pallets of metal from the system. Smart money choosing physical certainty over broken promises, possession over paper. Registered inventory, the only metal available to settle futures, is bleeding out at record speed. That stack is the backbone of the paper scam. It gives the contracts legitimacy. When registered collapses, confidence in the whole system collapses with it. It's happening at the absolute worst time. Banks are massively short. Industry is desperate. The arbitrage is broken. Swaps are frozen. Every ounce leaving the vault kills their flexibility. Every withdrawal tightens the squeeze. Here's the psychological shift most people underestimate. Once participants start demanding physical metal instead of paper contracts, the behavior spreads. No one wants to be the last one holding the bag. No one wants to discover too late that delivery is impossible. This is how confidence collapses first, quietly, then suddenly. The paper market can handle volatility. It cannot survive mass standing for delivery. Once enough people demand the real thing, the illusion shatters. At this stage, the market isn't balancing supply and demand. It's exposing who actually has the metal and who is swimming naked. And it's definitely not where the spot price suggests it should be. So this is where we stand, and this is where clarity matters more than emotion. What we are witnessing isn't a spike, it's not a bubble, and it's not temporary. It is a structural transition, a shift from a price rigged by leverage and paper promises to a price set by true physical availability and industrial necessity. Let's stack up the lessons clearly. First, when arbitrage snaps, the market stops being global and gets real fast. The paper price becomes a joke. The only thing that matters is physical availability. If you hold the metal, you make the rules. Second, extreme backwardation on the charts isn't a buying signal for paper contracts. It is a scream of distress. It proves the exchanges are terrified they can't deliver the physical goods they promised. Third, when vaults bleed inventory at record prices, that is not profit-taking. That is a run on the bank. Smart money is grabbing physical bars because they prefer metal over paper promises. For true stackers, the mistake right now is chasing fake headlines or trying to time the top. This isn't about guessing the next dollar swing. It is about surviving a currency reset. When the regime shifts, the tamp-downs stop working, the dips get bought up instantly, and the official narrative flips faster than the sheep can react. The best play isn't to panic. It is to stack harder, get off margin, and eliminate counterparty risk. You have to separate your paper investments from your physical holdings. And remember, the old rules of the game are dead. Rigged markets don't send you a warning letter when they pivot. They just show you the empty vault. What we are witnessing is the market completely losing faith in the fiat promise. If you are still here, you are already ahead of the herd. Keep your eyes open. Keep stacking disciplined, and never mistake a manipulated flat line for a healthy system. If this helped you see the real state of the economy, hit that subscribe button like the video and share it with friends who think nothing happens on holidays. Comment with the number 1 if you want me to keep exposing the data, or the number 2 if you want me to stop. The silence before the storm is when the real moves happen. And this moment is critical.